Hi, good morning. Thank you, everybody. My name is Andrew Fraser. I'm the Estate Manager for HUB24 here in New South Wales. Thanks for joining us for this month's HUBsights webinar. HUBsights being our monthly webinar series showcasing some of our fund manager and asset consultant partners on the HUB24 platform. Today you'll be hearing from Elston Partners. Elston Partners run a range of diversified managed portfolios on HUB24. You'll be hearing from Andrew Mckie and Leon DeVette, portfolio managers, talking about the benefits of using a managed account specialist. Following Elston, you'll hear from Thomas Reif from State Street, the Head of Quant Research and Portfolio Manager. He'll be discussing smart beta investing. The usual protocol for these webinars: each presenter will speak for 15 to 20 minutes each. At the end of both presentations, we will take questions. I absolutely encourage all the attendees to pose questions, either using the chat or question functionality in the webinar toolbar. So please use that functionality. Without further ado then, I will hand over to Andrew and Leon from Elston. Thank you.
Thanks, Andrew, and good morning, everybody, and thanks for the opportunity today to present Elston Asset Management as part of the HUBsights webinar series. My name is Mark Smith, and I'm the Head of Distribution here at Elston Asset Management. I'm joined by my colleagues and portfolio managers, Andrew Mckie and Leon DeVette. Now, a question I'm often asked is, who's Elston? And I'd like to say we're one of the biggest managed account providers you've never heard of. Elston Asset Management is a privately owned funds management business, headquartered here in Brisbane. We formally established in 2011 with a goal to leverage our managed account experience to deliver some great outcomes for investors. Now, rather than rush to market, we've focused the last 5 years on refining our 5 Ps: our investment philosophy, our policy, process, people, and performance, and building up a solid 5-year track record. We've had a great relationship with HUB24 over this time and have only recently gone live on the public menu after a number of years as a private label offering. As managed account specialists, we've been running managed account portfolios for almost 10 years now, and we've got a really keen understanding of not only the benefits, but also some of the challenges in managing assets via this unique structure. As I mentioned earlier, we've taken a very steady and considered approach to launching our SMA portfolios externally to the market. And part of this is not only building a strong track record, but also recently engaging Lonsec to get our Australian equity portfolio formally rated, a process we began in June this year. We've also invested heavily in building some great tools and resources for both advisors and clients, and during this time we've grown our portfolios considerably to now manage just over 1.3 billion in managed accounts on behalf of investors across Australia. In terms of our SMA portfolios, we take a consultative approach to working with both advisors and dealer groups around what exactly they are looking for in a managed account investment offering. We have a broad range of diversified risk-based portfolios available via HUB24, from conservative through to high growth, as well as our flagship Australian equities portfolio. And as part of our after-tax investment focus, we also offer both super and non-super variants of each model, something we'll touch on a bit later in the presentation. We also work with AFSL holders on building customised SMA solutions built around our direct Australian equity capabilities. And this can involve dealer input into the strategic or tactical asset allocation or specific asset class investments outside of Australian equities. At Elston Asset Management, we have a very experienced and well-established team of investment specialists, headed up by our 4 portfolio managers who are all shareholders in the business, and between them have an average experience of 19 years in the industry. We also have a team of analysts as well as distribution, operations and marketing support to ensure we bring a true funds management capability to our managed accounts offering. Now, the investment team draws on a wide range of experience and different backgrounds, ranging from investing directly for retail clients through to institutional analysts and proprietary trading. The investment managers are responsible for all the investment decisions and portfolio construction, as well as decisions around reweighting and ongoing management, whilst our analysts are responsible for data collation, research consolidation and quantitative reports. Now, I'd like to introduce 2 of our portfolio managers, Andrew Mckie and Leon DeVette, to take you through our Australian equities investment approach in more detail and how we leverage our managed accounts experience in running our SMA portfolios. Over to you, Andrew.
Thanks, Mark. Before we get into our investment management process for Australian equities, I thought it'd be worthwhile just looking at the history of managed accounts. winding the clock back a bit and just looking at the original intention there, and that was, as we see it, removing the unit trust structure for investors. So whether investors using a managed fund or an ETF, the capital's going through that interposed entity in the unit trust and then going through to the underlying asset themselves, whereas the intention around managed accounts is really to remove that interposed entity and go direct to the underlying asset. The challenge, though, is to be able to do that in a reasonably scalable and efficient manner, and this is what Hub's been able to achieve very well with their technology, both from our perspective as an investment manager, but also from an advisor's point of view. It is a very scalable and efficient platform to manage direct portfolios. And removing that interposed entity, really the goal of that was to provide those benefits on the right-hand side there for investors. So things like beneficial ownership and by proxy a little bit more control of their investments, maybe to take some cost out of the equation, to introduce some level of customization, and for us the two big ones, adding some transparency for investors around their portfolio and also being able to manage money on a tax-efficient basis. So if we just turn to after-tax return management for a moment, the way we like to see that is that removing that interposed entity really enables after-tax management to occur, and it is that intersection between the great strategic advice that you're providing as an advisor, great asset management, those two coming together to deliver efficient outcomes on an after-tax basis. So a simple example would be by grouping accounts by tax entity, we're in a better position to control the actual tax outcome, the net return for investors. And by doing so, really demonstrate the value of the strategic advice and make it a lot easier for advisors to articulate their value. Just turning to after-tax return management for a moment and just delivering it in practice. I've just got a simple example here of the structured buyback. This is the Telstra structured buyback. As Mark mentioned, we do run two models. We're the only managers to have tax-based models on the public menu, so super and non-super models for Australian equities. And as you know, structured buyback has a capital component and then a large fully franked dividend component. Depending on the investor's individual tax rates, it is very effective for them to participate in those structured buybacks. In the case of this Telstra buyback for more superannuation accounts. So in the superannuation model, we participated in that buyback, and by doing so, we deliver a tax-free benefit, a risk-free benefit to the investor. And when we think of that in a context of a low interest rate, low inflation, potentially low return world, if we can deliver a little bit more tax efficiency, it's extremely valuable to the investor. Now that does flow through a little bit to our investment process as well. We screen our universe based on the outstanding franking credit balances. We look at that versus the market capitalisation of that business. We then look at things like debt levels, free cash flows, to get a sense of companies that would be more likely to do structured buybacks in the future, or where it would be in the shareholders' interest for them to do structured buybacks in the future. And that does inform us at the security selection process, just helps in that selection process. Just turning to the second key benefit, and that is around investor transparency. So one of the clear advantages of a direct portfolio is the investor does see where their capital is invested. However, it poses significant challenges to you as advisors in that it really increases the level of scrutiny on the portfolio and the portfolio activity, and we see that as a real challenge for advisors that they need to meet. And we understand that. We have deep experience in managed accounts, doing managed accounts for over 10 years. So we incorporate that in things like the frequency of our rebalances, the number of changes to the model portfolio, and then the spectrum of resources that are available to advisors in terms of not only their ongoing communications, but the resources around how the portfolio is constructed so they're fully informed. An example, when we do make a change to the model portfolio, advisors receive a text notification with the rationale in that text, as well as an email, which they can then forward or co-brand or white label to their client base. Really enables them to demonstrate proactive management of their affairs, which is really important for client satisfaction for advisors. So that's enough for me for the moment. I'm going to hand over to Leon just to touch on more detail of investment management process for Australian equities, and then I'll come back to talk about portfolio construction and a little bit on performance. So thank you.
Thanks, Andrew. So in addition to the focus on after-tax management, the other core philosophies underlying how we think about constructing and managing portfolios are noted here. Now, given limited time, I'll just make some brief comments to hopefully provide a bit of a flavour on our thinking. In essence, building portfolios is certainly simply not around trading stocks, but it really is around buying into businesses and particularly the long-term earning streams which those businesses generate. Ultimately, earnings drive share prices, we believe, and critically, they underpin the dividends on which many investors obviously rely for income. The associated cash flows also enable shareholder-friendly capital management initiatives like the buybacks Andrew referred to. And finally, earnings are obviously also very important in supporting the balance sheets, which is essential in ensuring that a company actually remains a going concern. Those future earnings are, however, uncertain, and in many instances, the expectations for growth can be a little optimistic. And so it is important from our perspective that we do maintain discipline and obviously don't overpay for that. Given this uncertainty around the future earnings, we also don't want to be too overexposed to any individual companies or related risk factors for that matter, in case we are wrong with our assessment. We believe that delivering outperformance for investors requires not only that we pick the winners, but it's also important, given the miracle of compounding and investing, that we reduce the size of portfolio losses too. So what does an Elston equity portfolio typically look like? It is large cap focused. Our investable universe is the ASX 100 with a minimum of 80% in the 50. This is very deliberate because the portfolio is intended as a core holding in investor portfolios. It's typically fairly concentrated, generally sort of 20 to 25 underlying holdings. We do employ a fixed weight methodology, and as you'll notice, we have both minimum and maximum limits in terms of individual holdings. There are also some restrictions around sectors, and really this goes to those philosophies we have around diversification and trying to minimize losses. Now, from discussions with advisors, we certainly are aware of industry fee pressures and hence the attractiveness of low-cost passive ETFs. And we certainly would agree that there are instances where these passive index tracking investments make a lot of sense and have a role to play in portfolios. The Australian equity benchmark is, however, very concentrated, as we can see here. Now, maybe just to provide a little bit of context on what exactly that means in practice, I thought we'd just have a quick look at a $1 million portfolio trying to replicate the index. And what we'll see, if we were doing that, our largest holding being Commonwealth Bank in this instance, would almost have around 104,000 of our $1 million invested in it. By the time we get down to stock number 10, which happens to be Macquarie Group, we'd have a little over 510,000 of our $1 million invested in those top 10 stocks. Macquarie, by the way, would be about $21,000 of that amount. Now, if we move down to the bottom right-hand side and we look at stock number 100, well, in effect, primary healthcare would only have about $1,000 of that $1 million allocated to it. And in fact, if we look at the bottom 10 stocks cumulatively, that's a little over $15,000. So the bottom 10 stocks in our index, a little less than 1/7 of the largest stock in the index. And so I think what we can see is there's a very long tail. From a diversification perspective, they probably don't really add much, and certainly even if those stocks were to probably double, wouldn't have much impact on the portfolio. So for risk-aware investors, we do believe that an actively managed product offered at a competitive price is a compelling option, and especially obviously as a core holding in the Australian equity context. Now, despite our focus on the large cap universe, we do take truly active positions relative to the benchmark, This is largely as a result of our minimum positions. As I mentioned in the ASX 50, that's 3.5%, or in our example, that would be $35,000 in this instance. And really, just to illustrate, our minimum weighting is greater than all the weightings in the ASX 100 other than the top 7 stocks. It's also important to note that we don't have any tracking error targets relative to the benchmark. Turning briefly now to our process, it is a combination of both quantitative and qualitative. The starting point for us is really screening all the companies in the ASX 100 on a common set of growth and value factors, as we have noted there. I won't obviously touch on each of those. You can clearly see what those are, as well as valuing all companies using some common techniques. Now, as mentioned, we do believe that it's the company's growth prospects or earnings growth which is important, but we don't want to be overpaying for that, and hence the combination of both the growth and value factors. This quantitative process, we believe, in essence, forces us to do 2 things. Firstly, to consider companies which rank or value well, but which we don't own. And secondly, to reassess our thesis on companies which rank or value poorly, but which we do have in investor portfolios. We view this quantitative process as important because it's repeatable and it can be consistently applied. And because it is objective, it helps, in our view, to mitigate any of the behavioral biases which we as portfolio managers may exhibit. Now, to be clear, the final portfolio is certainly not quantitatively driven. Any inclusion or exclusion of holdings from the portfolio does require a fundamental assessment by the investment team. All decisions require majority agreement, so 3 of the 4 portfolio managers. And in our view, this helps to alleviate not only key man risk, but it also encourages discussion of opposing views. Finally, just on portfolio construction, I guess any portfolio changes are obviously not considered in isolation and certainly don't depend simply on expected returns. There are a number of portfolio considerations as noted. Andrew mentioned obviously full transparency that investors have, and so things such as turnover in client portfolios we believe are also important to monitor. With that, I'll hand it back to Andrew just to make some comments on the portfolio and performance.
Thanks, Leon. Just a couple of points I want to make here. Just on the left-hand side, just a rundown of our current main portfolio holdings. What you'll note there is our portfolio security weighting versus the benchmark. As Leon mentioned, we are true active, so we do not use a tracking error approach to determine security weightings. And although we have a very tight universe, that still gives us ample opportunity, we believe, to achieve outperformance over the long term. Just on the right-hand side is our sector breakdown as we currently sit in the portfolio. What I wanted to highlight there is just the sector diversification within the portfolio, particularly versus the ASX 100 or a passive exposure that replicates that index. It is a reasonably aggressive index from a sector point of view when we consider that retail banks and materials make up 47% of the ASX 100 index. So you can see a lot more diversification in our portfolio from a sector point of view, which goes to volatility of returns. In terms of how we think from an investment manager's point of view, what are our main goals? Well, clearly we want to achieve outperformance. We want to derive that investment alpha over the long term, but we want to be a core holding. We want to be a safe pair of hands for advisors. So for us, that's about consistency of those returns and those returns being sustainable over the long term. And that all comes down to the discipline of our investment process, continuity of our team, and that we do believe in being true active and not replicating indices. But the other forms of alpha are also important and don't get as much airplay as they probably should, and that's around tax alpha. So just using tax optimization to improve the net return, which we've mentioned is a risk-free benefit to investors. And then fee alpha, which is just being value for money. We've launched this product to be that nice sweet spot between passive and, say, active managed funds. And our view is that there will be more pressure through time on the advice value chain, whether that be the advice margin the platform margin or the asset manager margin. We think that is a good thing, and we're proactive on that approach. And our view is if we can deliver those three, if we can deliver outperformance, if we can deliver tax-effective returns, and we can deliver that low cost, that all goes to the value equation for you as an advisor and puts a lot less pressure on your advice margin over time. In terms of our performance, this is just the Australian equities SMA model performance from HUB. As Mark mentioned, we really wanted to have that 5-year track record before going through to market. What I would say is it's been very consistent performance over each financial year. We've been able to deliver outperformance, but also on a risk-adjusted basis, it's been very efficient in that the performance has been not taking a huge amount of volatility on over the index. That flows through to our multi-sector product offering as well. This is the public menu sorted by 3-year returns from HUB, and that is an off-the-shelf solution for your strategic asset allocation model. So for those practices that are just looking for a plug-and-play solution, that is available. However, we do recognise, as Mark mentioned, that a lot of dealer groups are looking to build their own private label offerings, and we would work with the HUB team to help you build those strategic asset allocation models as well. So that's enough from Leon and myself. I'm going to hand back over to Mark just to wrap up, and then we can take questions at the end. Thank you.
Thanks, Andrew. So to summarise, Elston Asset Management really provide a true active Australian equities capability within a managed account structure, and on top of some of the solid and consistent returns Andrew mentioned, we also deliver some really strong fee alpha through a very competitive MER of 44 basis points on HUB24. We've got more than 10 years experience in running managed accounts and a real strong focus on the after-tax outcomes via both our super and non-super model variants. And on top of the full suite of Australian equity and diversified models we offer on HUB24, we're, as Andrew mentioned, we're very open to working with AFSL holders looking to build their own managed account portfolios via a private label solution on HUB24. As a business, we've worked very hard to not only deliver some pretty strong results for investors, but we put a lot of effort into building resources for advisors and clients that use our portfolios. And this is not only around the proactive communication piece and the online resource tools we mentioned earlier, but we've got a very experienced BDM team to support you in implementing the Elston SMAs within your business. Finally, by really continually investing in our team and having our portfolio managers as shareholders in the business, we believe we've created a very stable and aligned business, which is, we think, critical to building long-term relationships with our clients and investors. So we'd like to thank HUB24 for the opportunity to speak today, and thank you also for your time. I'll now hand back to Andrew and obviously open for any questions you may have at the end of the presentation. Thanks, Andrew.
Sorry, I'm mute. Thanks, Mark, and thanks, Leon and Andrew also. Just to reiterate that, anybody got questions, please a reminder to log those through the toolbar, the questions field, or the chat. I'll now hand over to Thomas Reif from State Street. Thanks, Thomas.
Good morning, and thank you for your time. My name is Thomas Reif. I'm a global portfolio strategist at SSGA. State Street, the third largest fund manager in the world, with a global reach, investing in every listed asset market in the world. And look, today I'm here to talk about smart beta, but I think before we talk about smart beta, we probably should start with the most important investment decision that you can make with your clients, and that firstly is asset allocation. Once you get your assets split between risk assets and defensive assets, you're comfortable with that split, the implementation then becomes a trade-off between cost and returns. And the current buzzword in the marketplace, although it's been around for a long time, is smart beta. What smart beta is a low-cost way to enhance your portfolio return. So while I let you read the slide up on the screen, I'd like to talk about putting together a basketball team. Now, if I start with a class, and I'm a passive investor, I would take all members of that class, and they'd all be on the basketball team, and I can randomly select 5 individuals to go on the court at any particular point in time, and that would be my basketball team. But if I want to be a little bit smart about putting together a basketball team, I'd probably line them up by height. Height, perhaps sporting ability, perhaps jumping prowess and some ball skills. And if I chose those, the 5 tallest or the 5 with the best aggregated score based on running ability and jumping ability and ball skills, I've probably got a better chance of winning the basketball tournament than if I just taken all comers. And that's what Smart Beta is about. Smart Beta is about putting together a portfolio or a team of stocks that is biased to outperform in the long term. It sits somewhere between that nexus of active and passive. The return stream that you get from Smart Beta, no question, is active. It does not blindly replicate a benchmark. It tilts the portfolio towards characteristics that have been shown to outperform the long term. But it's a lot like a passive portfolio. It's rules-based, it's disciplined, it is transparent in the way that it is put together. So you really do know what you're getting when you buy a portfolio of a Smart Beta portfolio. It's just that nice little nexus in the middle. Now, Smart Beta isn't guesswork. It isn't about having spoken to management and looking into the eye of management, having a belief in them. It's based on evidence. It's based on research across many markets by many practitioners that we've reproduced in-house. So it's very much a scientific way to construct your portfolios. So, look, if we want to tilt a portfolio towards characteristics that outperform, what might those look like? I mean, if it was sports, it'd be things like height and speed and strength and ball skills for basketball or football. When it comes to outperforming an equity market, for all the talk and all the noise, there are a select few factors that have been shown to outperform the market across many markets by many different practitioners, and also that we've reproduced in-house. Let me just take a couple of examples. You can see there is a value premium in the market. It's been around. It's first discussed in 1930s by Benjamin Graham and Dodd. Relatively low price stocks outperform relatively high price stocks over the long term. Now, you might remember going back into the tech boom of 1997, 98. Earnings didn't matter anymore. Fundamentals didn't matter anymore. Value went out the window, and these growth stories, these almost fictional stocks just rallied really hard, and value was underperformed for a number of years. But lo and behold, earnings did matter, cash flow matters, book value matters, sales mattered, and when the tech boom crashed, value stocks outperformed and made up more than what they'd lost in the rally of the tech boom. Now, the size effect has certainly been around, been mentioned, and that's why there are a lot of small cap managers out there. I won't spend too much on time. What I'd like to talk about a little bit is volatility. Now, there's a risk and return relationship. Higher risk equals higher return. That certainly is the case between asset classes. But within an asset class, the research shows that relatively low volatility stocks outperform stocks with relatively high volatility on a risk-adjusted basis. There's been a lot of research that has been done that demonstrates that stocks with low volatility outperform stocks with high volatility. Another thing that Andrew and Leon mentioned as well was quality. We view high-quality companies tend to outperform lower quality companies in the long term. What does quality mean? Quality means things like a low level of gearing, stable earnings, high return on equities. Those type of characteristics tend to outperform an unbiased market in the long term. And last but not least, everyone's favourite smart beta factor in Australia is dividend yield. Stocks with high dividend yield, that you've got to augment with a little bit of quality. You can't just buy yield at any price or any level. Tends to outperform in the long term. So look, let's see how we can put together some smart beta portfolios. Now, first of all, if you start off with a cap-weighted benchmark, that is an extremely hard hurdle to beat. The smart beta factors have been shown to outperform that. The select few smart beta factors have been shown to outperform over the long term, but the path to getting that can be a little bit volatile. So you may not want the tail wagging the dog of smart beta, so it may be worthwhile diversifying across your smart beta characteristics. And why might you do that? It's because they respond differently to different parts of the economic cycle. Ones that are easiest to understand are probably things like quality and low volatility. In an economic downturn, or at least when market participants think that the economy is turning down, gearing matters. All of a sudden, cash flows become stressed. The ability to pay back your debt matters. And that's when you find companies that have a lower level of gearing, stable return on assets, and a high return on equity. They tend to outperform when the market thinks that the economy is turning down. When there's a recession, stocks that have low volatility tend to outperform. Low volatility means they're probably fairly predictable. If they're fairly predictable, they've probably got a fair amount of control over their expenses and their revenues, and they're the sort of companies that you want to be in when economic conditions are a little bit tough. On the flip side, when there's an economic recovery and there's a boom going on, the market floats all boats. And at that point in time, it's probably appropriate to take a little bit more risk. Smaller companies tend to be riskier and can be a bit more dynamic and flexible with regards to engaging with the market and changing their production systems to cope with the new level of demand. Similarly, so in times of economic recovery, you tend to see small-sized companies outperform. So we've looked back since 1992 to show 3-year rolling excess returns for global stocks compared to the MSCI World Index. If you put together a portfolio of companies that's tilted towards value, you can see that in 96, 97, 98, when the tech boom was going on and value didn't matter anymore, value companies underperformed. When the tech boom crashed and value mattered, the old traditional companies which had stable cash flow and high level cash flow to earnings, sales to price, and dividend yield and book to price, all of a sudden they rallied really strongly. And the underperformance that value suffered in the tech boom more than came back on the exit of the tech wreck. Similarly, you can see that high quality companies, the rolling return to high quality companies they've typically performed stronger than the market. Even around the tech boom, they were outperforming, and come to the GFC, around 07, 08, the return to high quality companies, those companies with low levels of gearing, stable earnings, and stable return on assets and high level of earnings, outperformed very strongly. And what you can see here is that different factors, these different characteristics, perform at different times depending on where you're at in the cycle. And it's for that reason that we think combining factor portfolios rather than putting all your chips on blue or all your chips on red with one factor is a more appropriate way to structure your portfolios. So, look, probably the most popular factor in Australia is yield. But yield at some level, particularly the high level, becomes a conflict. Yield is a conflict between management and the market when the yield is above 10%. The management's saying, you know what, I can maintain my yield above 10%, and the market says, look, no, you can't. If you look at payout ratios, free cash flow, and a consistent ability to deliver dividends, above 10%, the share price the dividend yield, the dividend paid tends to be cut to normalise the yield. They can't maintain the dividend yield above 10%, whereas those companies that have had a relatively conservative payout ratio, have paid dividends for the last 10 years, have a high free cash flow, they tend to deliver a strong, solid, stable level of return throughout the market cycle. So it's in yield. It's not just yield, but it's the quality component that delivers a strong return to investors. In Australia, there are at least two opportunities, two ETF vehicles that you can use to access dividend yield. The Spider MSCI Select High Dividend Yield Fund is an ETF that can give you exposure to 40 stocks with just through the purchase of one security with a fee of sort of 35 basis points. Whereas you can get the Global Dividend Aristocrats ETF has in the order of 100 securities that again have these quality. Both of these ETFs have the quality characteristics of 10 consecutive years of stable or increasing dividend yield, strong balance sheet, a low payout ratio, and stable earnings. Now, before we showed the factor returns, the variability of factor returns through the economic cycle. To provide a smoother return stream, we like to diversify across multiple factors which come in at different parts of the cycle. A strong global core style holding would do things that give you exposure to lower volatility, higher quality, and relatively good value. And as these three factors diversify across each other to smooth the return stream over time rather than dilute the return stream. The defensive characteristic of quality protects the portfolio in times of economic downturn, as does the tilt towards low volatility, yet value enables the portfolio to capture the risk premium when the economy starts becoming quite bullish. So one of the three factors tends to be firing at any particular time. In Australia, that can be accessed via our quality mix fund, HUBsights, which holds 507 securities across 23 countries, a lot of sector exposure that you just can't get reasonable exposure to in Australia, like tech and healthcare, can be accessed through this ETF. So look, in summary, smart beta are a series of characteristics that we think outperform in the long term. We think based on evidence and research, not just based on opinion. And these premia that come from the exposure to the factors of value and size and momentum and quality or low volatility or dividend yield, these premia can be captured through transparent, systematic and disciplined investment processes. So what are some of the advantages from a smart beta portfolio that can bring to your client's portfolio? A core holding with an enhanced return at a relatively low cost relative to an index fund, so you can get the most out of your fees. Yield ETFs protect investors with a quality tilt towards yield, giving your clients a regular level of income. And note that it is time in the market, not timing the market, that's important with smart beta. And diversifying across factors and holding those smart beta portfolios through the economic cycle can allow the investor to benefit from this consistent and disciplined exposure to these return drivers. If there are any more questions or you have some interest in pursuing these ETFs, just look at the Spiders website, or you can contact Andrew Kalapidis of SSGA.
Terrific. Thanks very much, Thomas. Thanks to both our speakers. We might now have a look at what questions we've had come through. We've had a few come through, thankfully, so keep them coming. We can take them as they come. The first question we have is for Elston Asset Management. How do you manage the downside or for market correction? Andrew or Lena, if I can pose that to you.
Thanks, Andrew. Look, I think firstly, in terms of market correction or downside protection, the portfolios have to be seen in the context that they are clearly long only. Obviously that is the mandate certainly for the Australian equity component. Having said that, we do have the ability to allocate a maximum of 23% to cash, so there is that ability to provide some downside protection. But as I say, certainly it is a long-only product and so it needs to be seen in that context. I guess the other thing that we certainly do have the ability to do, given that we are not benchmark constrained, is certainly look at the underlying holdings and try and be more defensive in terms of things like quality, I guess, which the other presenter had mentioned. So it's really around, I guess, trying to get more defensive in terms of those exposures. Also, when we are looking at our portfolio construction, as mentioned, we certainly do have a focus on what we're paying for future earnings growth. We're trying to get that value underpinned within our portfolios too. So I don't know if Andrew's got anything to add to that.
No, apart from also the large cap universe, from a liquidity point of view, during periods of market dislocation, you tend to get a lot of price action, particularly in the small to medium cap market, whereas we are able to, given our universe, move out of positions fairly easily from a liquidity point of view without that impacting price. So I'd say value overlay, ability to tactically allocate to cash to some degree, and then liquidity.
Okay, terrific. Thanks, Andrew and Leon. Got a question here for Thomas at State Street. How do you bias your portfolios to the characteristics or factors you want?
Thanks, Andrew. Look, let's consider a value portfolio. How might you... This holds for any of the factors, but let's just say we'll start with the value portfolio. How would you bias that towards a value, a unbiased universe towards value? Take all the stocks, throw them up against the wall, such that the relatively low price stocks fall to the right-hand side and the relatively high price stocks fall to the left-hand side. Now, if you cut that universe up into quartiles, so 25% of the relatively highest price stocks down to 25% of the lowest price stocks, we've got a starting base of little quartile that we can work with. What we now might want to do is to tilt the portfolio towards value. You might want to take a higher weight of those securities that are relatively low price, let's call those that attractive quartile, and a low weight to those stocks that are relatively high priced. So if you start with market cap as your weight, you might hold 3 times the market cap of a relatively low priced security, a value security, and you might hold none of those stocks that are the most expensive. And in between, sort of overweighting 3 times your most attractive stocks down to not holding any of your least attractive stocks, you scale down your holdings. And that gives you a portfolio that is biased towards the value characteristic that you're trying to harness for that value premium.
Terrific. Thanks, Thomas. We have enough to keep going one for one here, so this is great. Directed to Elston Asset Management, what will be the impact of Amazon? There's a few curious people on that. Andrew and Leon?
I'll have a first stab, and then Andrew can obviously add his comments. Clearly very topical issue at the moment. Look, I think, personally speaking, the online market share capture trend, I think, does have further to go. There's probably no doubt about that. And as a result, it probably does necessitate a rethink by traditional retailers in terms of their expanding via new stores type strategy. And I think Amazon certainly will add further pressure to an already sort of competitive sector here within Australia. But I think it is a bit naive to simply extrapolate the success that they have had offshore, particularly in the US and the UK markets, where expansions really did start when online retailing was in its infancy. And I think if we look at countries like Canada, probably the success there hasn't been as convincingly demonstrated yet. So, I think retailers have adapted their business models. They will continue to do so. Omni-channel retailers, we think, probably can compete with Amazon in certain respects. and certainly those physical stores which they have developed over, many years do potentially provide some sort of advantage in terms of that last mile distribution. So, I think the other thing that is quite important is that the products that are sold and the extent of the threat therefore for the various online retailers is not homogenous. I think some products are probably more easily sold by Amazon than others. And I think, I guess in a nutshell for me, there are certainly omni-channel retailers here in Australia. I think the likes of probably JB Hi-Fi, maybe even Harvey Norman, which do have lower costs of doing business. I think they probably can compete quite effectively with Amazon going forward. But there will undoubtedly be those that go out of business, and there'll be some consolidation in the industry. Andrew, I don't know if you've got anything else to add.
I think there is a little bit in terms of pricing of current securities that it's going to be a bit of a binary outcome where Amazon wins and everyone else loses, and I just think it's not as simple as that. It'll depend certainly on category as well. So if you think about the category of retail, in some instances it's just not suited to online. If you think of luxury goods, if you think of furniture and the like. We were fortunate enough to join some other fund managers and analysts on a recent tour to go to the Berkshire Hathaway AGM, and we met with Nebraska Furniture Mart, the management of that business, which is a subsidiary of Berkshire Hathaway. They're like a massive Harvey Norman in the States, and so Amazon was a key topic of discussion there. They basically said that electronics is something that they wouldn't see much of a future in. They hold that category just merely because they need to be a one-stop shop, but they have virtually no margin in that. So that would be a category example that could come under a significant pressure where it's quite a homogenous product. So our view is to be fairly cautious. There will be opportunities, but our sense is to maybe look elsewhere and see how things develop from a competition point of view.
Great, thank you guys. The questions keep going. So for Thomas at State Street, could you explain time in the market rather than timing?
Thanks, Andrew. Look, time in the market rather than timing the market really speaks to the fact that we acknowledge we don't have a crystal ball. We can't tell what the future is going to bring, but what we do know is that the research we've done suggests that the smart beta factors that we've presented today outperform in the long term, but that outperformance is cyclical. Value factors come and go at different times to low volatility or high quality factors. They all outperform in the long term, but they do so at different rates and at different times. And so rather than jumping from, say, single factor portfolios like your value manager or small cap manager and trying to time which characteristic and which area of the market is going to be hot in the next couple of months or the next year or two, we take a fairly stable long-term approach to investing where we diversify across multiple factors and many securities in a low-cost way to try and deliver excess return to investors through a long-term holding period.
Very good, thanks, Thomas. I think this is the last question we've got. If there's no more coming through, but for Elston Asset Management, is what has been the historical yield and what is your future yield?
Okay, so in terms of historic yield, I guess when we're thinking of the blend portfolio, really what we are thinking of is over time to be roughly matching the yield of the index. As I mentioned during the presentation, though, we certainly aren't benchmark aware, and as everyone would have noted, we are quite underweight the retail bank. So currently the yield on the portfolio is just a little bit over 4%. That is obviously under the benchmark weighting currently, where the 30-odd% in the index to retail banks, which are amongst the highest dividend yielding stocks, is obviously helping to lift that the benchmark yield a little bit higher than what our portfolios are. So we are underweight given the sector allocations, but as I say, over time, generally trying to sort of be round about the yield of the benchmark. I think just two other points, or one other point just to note. It's for us, it's not only, I guess, around the dividend yield currently, but certainly we are looking, forward to the future and the ability for companies to grow yields. And we do think that there are a number of opportunities, certainly within our portfolios, where that dividend expansion is going to come through, as a lot of companies which have been investing in their businesses and having slightly higher capex requirements as that rolls off and the cash flow increases going forward. But I don't know, Andrew, any other sort of comments?
No, I think it's a total return equation as well, so balancing yield and capital growth. I think capital management is also important. We mentioned structured buybacks earlier. What I would say is that the balance sheets for Australian companies look very strong. Some of the positioning of the portfolio you would regard currently as being slightly cyclical. So from a forward-looking, if you look at absolute yield at the moment, it is probably a little bit lower than historic, but forward-looking, as those companies come out of that more cyclical low, you'd see that translate in terms of cash flows and dividends. We think of companies like Rio Tinto, for example, is likely to pay a record dividend coming out of the recent downturn. So, combination of total returns important, but at the same time, particularly for superannuation accounts, pension accounts, we are very focused on franked dividend.
Yeah, sorry, and I know some here joke that I'm always trying to get the last word in, but I think just following on what Andrew has said, I think that those structured buybacks certainly are important. Now, clearly, we don't know with any definitive certainty what is going to happen in the reporting season, but if we look, for instance, at our portfolios, we know that at the end of 2016, certainly, sort of the top 6 companies in the ASX 100 with the largest franking credits per share, we own all of those, and so we certainly do think that there is the possibility, for some benefit in the reporting season going ahead.
Great, thanks, Andrew and Leon. We've had another question come through for State Street. Does State Street plan to release an ETF for single factors, e.g. value, rather than multi-factor as discussed today?
Thanks, Andrew. Look, we're always looking at new opportunities in the marketplace, and particularly in consultation with advisors. If we see there is sufficient demand from advisors for particular types of exposure, we're happy to explore those.
Okay, terrific. All right, and you have any further questions, we will wrap things up there. Thanks for your dialing in and for your participation. I want to thank both managers, Thomas at State Street and Andrew and Leon at Elston Asset Management for presenting today. If you do have any questions post this session, by all means, please get in touch with us, your Hub representative, or if you would like to be arranged to speak with Elston or State Street, also come through. We're happy to arrange that for you. Thanks again to everyone for dialing in, and thanks to our presenters.